All right, for my presentation, we were asked to look at 20 plus companies and decide, which company that we thought would be a good company to invest in and a company that, is moving forward in a positive direction in the future. So in looking at the companies, I just did kind of a eyeball of the 20 different companies. I looked at some different ratios that made those companies up. And I came down to, 4 or 5 that I liked, and I decided to go with Poolcorp. And the reason I went with Poolcorp is they're a local company. They're based out of Covington, Louisiana, which is up the road from where I live in Mandeville. I've always heard the name Poolcorp. I've known people that have worked at Poolcorp. Thought it'd be an interesting company to analyze. So I went forward with the project, and before I get started and before I start digging into a lot of the ratios and the different financials that make up the company, just want to give you a brief overview of the company. So they were founded in 1994, so they've been in existence for almost 20 years now, and they are a wholesale distributor in the pool market. But they started off selling essentially to new pools, so that they wanted to sell to new pool owners, and that was essentially their marketing strategy, was selling to people that were building pools. And over the years, they've actually, I think management's done a good job because they've expanded what they've sold, and they actually sell now to not just new customers but also existing customers. And they go after a larger market base, and they can get the annuity value of that repeat purchase because they redo pools, they help maintain pools, they sell landscaping products and all kinds of different stuff. So they're a wholesale distributor. They sell to retail outlets who then turn around and sell it to the everyday consumer like you and I. They are the largest wholesale distributor in the world. They are a global company. They have over 3,200 employees and 300 plus locations. And we've got a black screen going, so we'll keep rolling though. They have over 80,000 wholesale customers worldwide. So they actually they have over 80,000 people or companies that actually sell their product. And they have over 160,000 national brands. So they have a lot of different types of products that they keep in their inventory, and they're able to turn it and sell it. That's a positive. One of the negatives, I guess you could say, with this company is they are essentially they have 3 main suppliers that make up about 40% of their inventory. And if any of those suppliers tend to or decide they want to go directly to the retail outlets and sell to them, or if any of them decide to close shop, that could be a hindrance in their business, because Poolcorp will have to go elsewhere and try to find other outlets to sell their products. So that's a little background on Poolcorp. So moving on, what I did was to start here, I decided to create an efficient frontier, just a quick graph with 5 companies that I thought looked good in my eyes. And being a risk-averse investor, I wanted to see just kind of which companies look the best in terms of where I can get the most out of with the least amount of risk, best return out of least amount of risk. And Poolcorp is actually right here. 3M is right there. Marathon right here, and then we have the Shaw Group is down here. No, Shaw Group is actually I think down here, or CF Industries is right there, and Shaw Group's right there. And you can see, just comparing Shaw Group to Marathon is going to beat Shaw Group all day, because they're going to give them basically the same return for less risk. And, larger return for the same amount of risk. And then if you move over here, 3M and Poolcorp, I thought Poolcorp was a little more risky, but thought it would be a good company to look at with the returns they were getting for the amount of risk they were given. Next, I'm going to walk you through some of the different ratios in regards to short-term solvency, long-term solvency, asset management, some of the profit ratios, and then market ratios. To start off, just wanted to take a look at in terms of can Poolcorp pay their bills on a short-term basis? Do they have enough in their current assets to meet their current liabilities? And in looking at the ratio, the first thing I'll point out here is the quick ratio. The quick ratio is essentially, you can see if you compare the quick ratio to the current ratio, about 75% of their assets, their current assets, is tied up into their inventory. So, being a wholesale distributor, that doesn't surprise me one bit, because their income, their sales are predicated on the amount of inventory that they have. So for 2010, 2011, 2012, that's essentially where we're at. 75% of their assets are tied into the inventory. But 2008 and 2009, as you'll see, those are years that kind of stand out in this whole analysis with the recession that happened. that they were going through, that we were going through, they had actually 20% of their current assets were tied into other assets. So essentially 95% of their assets were tied into their quick ratio. They don't keep a lot of cash on hand. It's not needed for this type of business, but they're still able to meet a lot of their current liabilities with their current ratio having a ratio of over 2 for the most part each year. And the fact that they do turn their inventory, which they can turn it into cash, it is liquid for them, is a plus as well. And because their inventory they do have such a lot of their current assets are tied into inventory, what I did is I just wanted to look at their inventory turnover, and as you can see, it's improved each year from 2008 to 2012. Right now, they're turning the inventory over about 3.5 times a year, which essentially is, every 103 days they're turning the inventory over, which it doesn't seem like a lot, but when you have $400 million in inventory, the fact that they can turn it over 3.5 times, that generates close to $2 billion in sales, I would consider that to be a plus. In terms of just being able to get a feel for how well the company uses their interest and if they can pay their interest and if they can pay their long-term creditors, I wanted to look at the cash coverage ratio, which is earnings before interest and taxes plus cash over or plus depreciation over the interest expense, and that's improved each year, which is good to see. And right now they're able to pay it 25 times, so they're not. They're a liquid company in terms of short term, but they're also long term. They're not going to have any issues paying their bills because they can meet that interest expense 25 times over the course of the year. Next ratio I wanted to look at was I wanted to get a feel for what type of return they were getting on their assets. So what type of how are we managing our assets? How's management doing and making sure we're getting the best return on the assets that we're actually using, or our investors are using their money to put into the company. And as you can see, that's increased over 50% over the last 5 years, and right now they have about a 10.5% return on assets. So their net income over assets is essentially 10.5%. So next one, return on equity. This is the single most important ratio when it comes to analyzing a company, because this is what what the return the investors are getting back for the money that they put up. So we want to look at this, and you can just do a quick view and see that from 2008 to 2012, it's gone up about 15%. But this doesn't tell the whole story. We want to see what's driving that. Is it debt? Is it asset management? Is it profit margin? So what we did was we broke it up. So we broke up the return on equity for over 5 years. And the 3 things I looked at was operating margin, asset turnover, and equity multiplier. And the reason I looked at those is because essentially profit margin or operating margin is you're taking tax burden and interest burden into account when you're considering your operating margin. And when I'm looking at return on equity, I'm looking at operating margin and asset turnover. I want to see those improve, and then the equity multiplier, I wouldn't it's not a bad thing at all when you see that actually decrease over time, because that means you're paying off their debt. And in this particular case, the margin for the company has actually increased 18.5%. So management's doing a good job in increasing, how they're using and how they're getting profit back on an operating standpoint over the years. They've also increased, how they're using their assets. So total asset turnover is essentially it's sales over assets. So they're getting more, bang out of their assets, or they're getting more sales out of their assets each year, and they're improving that each year. And then from an equity multiplier standpoint, you're actually seeing that go in the opposite direction. So they're actually decreasing the amount of leverage that they have because they're paying off their debt. So in terms of looking at return on equity, if you go back, you can actually see it's increased each year, or it's increased, from 2008 to 2012, or 2009 to 2012. It's increased 15.5% over the 5 years, but it's increasing in the right areas in terms of operating margin and asset turnover. It's not increasing because we're increasing our debt. I want to look at market ratios, and the reason I put this on here was I find it interesting what management's doing in regards to their stock buyback program that they have. But before I go there, if you just look at their price to earning ratio, you can see it's actually increased from 19.6 to 23.5 from 2010 to 2012, which essentially is 20%. So investors are feeling confident about the stock. They're feeling good about where it's going. They feel like it has future growth opportunities. And if you look at the price to earning ratio right now, it's at 29. So it's continued to increase. Now, that's the positives. Investors are confident. They feel like they have growth opportunities. But the negative could be that potentially it's priced out. It's at a high price to earning, and it's going to come back down, which would make it maybe a more risky investment. So, but I like to think, just from the analysis that I've done and management's track record, that it's increasing for the right reasons, and I still see future growth opportunities with the company. Shares outstanding. I put this on here because if you notice, they had 49.3 million shares outstanding in 2010. What all shares outstanding is the stock price multiplied times the number of shares outstanding that are being sold on the public market, on the stock exchange. It's decreased by roughly 3 million shares. So the company has actually strategically bought back a lot of their shares over the past couple of years. And they've done that for several reasons. One of them is they feel like there's not a better investment out there than their own company stock. So management has been buying their stock back, which is increasing shareholders' wealth. It's actually increasing the book value of the actual the company by 6% over that time frame. They've also, their price to book ratio has almost doubled over the last couple of years. So essentially, for every dollar that investors have invested in the stock, they're getting $6.96 in future cash flows. So by strategically buying back the shares, they've increased their shareholders' wealth. They've increased the earnings per share, and it's also driven the stock price up. So I think management's been very shrewd in that manner, because they're doing the right things because they feel like their stock's at a bargain. I think that's important to point out. If you look at their just the history of their stock price, you can see in 2008 it was at $17.97, and it's actually gone all the way up to $51.69 in 2013. So it's increased 188% over 5.5 years. That's the definition of a growth stock, in my opinion. It's a growing company, the stock's growing at the rate it has. It's a pretty good return on investment, and I'll show you how that compares with the S&P 500 in a couple of slides later. But it's outperformed the actual market. Give me 1 second. Next slide, market cap. The reason I showed this is you can see the market cap of the company has increased from 866 million to $2.37 billion in 2013. Basically, it just shows it's an interesting slide here, because the company's bought back a lot of their shares. I just showed you a slide where they bought back 3 million shares, but their market cap continues to increase because their price is increasing, even though management has bought back shares. Their price is increasing at a faster rate, which is making their market cap larger. Anytime your market cap becomes larger, that's a good thing, because it keeps away potential chances for companies to come in and try to buy the company, or have a takeover or anything of that nature. So for that particular purpose, it's a more liquid stock as well, because it's going to be traded more actively to more shares that are out there on the market. EVA. This is an important slide, and let me explain this. So essentially, what this shows is the economic value impact that the company, the management, is having by using the assets that investors are giving their money to use for the company. And how this is broken up, Poolcorp essentially is 89.5% equity financed, 10.5% debt financed, and the cost of capital for using equity and debt is 10.7%. They essentially have put $530 million of invested capital into the business, and they're expecting $56 million back. And as you can see, management is giving them $93 million in net operating profit after taxes. So that economic value impact is this number subtracted from this number. It gives you $37 million. They're giving an economic value impact of $37 million back from what is required of them from a weighted average cost of capital standpoint. Their return on invested capital is 17.63%, EVA spread is 6.98%. This was for 2012. Now, if you want to look at just kind of this is a little bit of an eye chart, but if you want to look at just on average, over the last 10 years, you can see on average, their weighted average cost of capital is 9.8, their return on invested capital is 16, and their EVA is $35 million. So essentially, their average is pretty much what 2012 was, and they're giving an EVA spread of 6, so 6%, which is pretty even to what the previous slide said. So that shows that management's doing a good job of using the money that investors are putting up and using it correctly and giving it more of an impact from an investment standpoint. Beta. So what I'm looking at here is I just want to look at the stock's volatility compared to the market, and the beta of Poolcorp is 1.165. So essentially, it's about 16.5% more volatile than the market. So if the stock market, goes up 20%, this particular stock might go up 21.65%. And then the opposite can happen if it goes back. So it is more volatile than the market. But with that being said, that's been a positive for this particular company over the years, because the company has grown and the stock price has grown with it. The relative volatility is 1.57, and I just got that just to show the volatility of the stock. I just took that, basically divided the beta and divided it by the correlation, so our correlation, and got the 1.5743 to show the volatility of the stock. And this was the slide I was talking about earlier. So if you look at just the last 5 years, if you look at Poolcorp versus the S&P 500, you can see they move in the same direction, which is essentially what that beta of 1.15 is. They're going to move in the same direction, but Poolcorp is going to move at a greater degree than the S&P 500 because it is more volatile. But you can see it's outperformed the market by quite a bit over the last 5 years. So if you were investing in Poolcorp, you'd be quite happy with the returns. So where will the stock be priced in the future? So what I did to determine where I think the stock's going to be priced in the future was I looked at their predicted earnings per share and their predicted price to earning ratio. I just multiplied them together, and based on the different earning per shares that I got from reading management's idea of where they think their earnings per share is going to be in the future, and then looking at Bloomberg, I came up with a number between $2.13 and $2.23, which gives me a stock price between $52 and $54. Essentially, that's going to increase your stock price from where it's at today 1.5 to 6.12%. It also pays out a dividend yield of 1.4%. So, in terms of, do I see Poolcorp growing at the rate it has the last few years? Not necessarily, but I still think it's a good investment. I think it's a safe investment, and I think given management's track record, you can only expect good things from it moving forward. So in conclusion, some of the concerns I have with this particular company are just the seasonality of the business, being that they do sell they sell pool supplies, they sell to new pool owners, to existing pool owners. The fact that the weather could have an impact. I know this year alone, management was a little bit worried because the weather, it was really cold and it was cooler in the winter. They had a longer winter in certain areas, which made their business not start as fast as they would have liked it to. The economy, as the economy goes, this company in particular goes. If the economy's in a recession, this company's going to feel it more so than maybe others, because this is more of a luxury item. It is not a need. Why do I like it? Because they've been stealing market share. Anytime you steal market share from your competitors, that's a plus. And the more you're doing it, you're growing the business in the right way by stealing market share. Construction of new pools, refurbished pools is increasing. So according to management, they're bullish because the market itself is growing, and they've been known to outgrow the market. Expected industry growth of 4 to 7%. Share repurchases. Anytime management feels that bullish about their own company to buy back the stock instead of investing their money elsewhere, I think it's shrewd, but I also like it. Shrewd management and management's track record. I think management's on to something. I like what they're doing. It's a well-run company. I see bright futures ahead. Thank you.